why would you look at gold and silver when it's not performing in the face of a war and inflation? It's exactly what they want you to believe. The inability to continue to naked suppress the price of gold and silver because the rest of the world will stand for delivery. You'll see great volatility. I would be shocked if you saw a 3 handle on gold, and it would last a matter of seconds as the arbitrage would just gobble it all up.
And why should I buy precious metals if they're being suppressed? The power players or the government wants them suppressed.
You're selling short to offset what you have in that you're working on refining.
Yeah.
And the price kept going up so fast, their short position was getting margin call, margin call, margin call, margin call. And then they're raising margins, more margins, more margin, more margin. And if you don't post that margin, you get stopped out in 24 hours. That the big money is quietly exiting stage left with as much in the way of chips as they can. These countries who are now all connected with their system and their vaulting infrastructure will be the ones that control what the price truly is. Any exchange that can say oil is negative 40 a barrel shouldn't be an exchange, in my opinion. The Western price is make-believe, Adam, because it's never been allowed to find price discovery. Because what is it? It's the antithesis of the Western system. Gibson's paradox, which largely speaks to the inverse relationship between real interest rates and the price of gold. And so when you suppress real interest rates, not nominal, real rates, for as long as we have, well, gold should go to the moon. So this is the incentive for stepping on gold and not allowing it to find its real price discovery. And the same thing is true of silver, where it's needed in so many major factors, from industrial to military and everything in between. I think the military-industrial complex has held it down. It's never been allowed to find price discovery, and the West doesn't get that. At least the people don't. The leaders do. But the people in the East understand this, and that's why they're using it against us and standing for delivery and keeping this arbitrage here. Come on, send it to us. Go ahead. Become rich in your dollars.
I think they love that it's low, right? If you're going to build basically vaults in stock.
That's why they're not bitching about it until all of a sudden it's delegitimized. Because remember, there's only one place in the world where price is set. Here, we set the price. So if they join into the party, suppress the paper price with money that they have coming out of their, every hole in their head, there's money coming out everywhere. So they sell the paper price and stand for delivery everywhere else, including here, at subsidized prices. You can see the playbook. I mean, at some point that stops.
Gold is behaving far better than real interest rates suggest it should. And that discrepancy is where the real story begins. Andy Schectman notes that suppressed real yields should have produced much stronger precious metals pricing long ago, raising questions about whether the paper markets still reflect actual demand. The overlooked detail is that Eastern buyers appear increasingly willing to take delivery, while Western investors remain focused on paper quotes. For wealth preservation, the risk may be trusting the benchmark instead of the underlying flow of metal. Next, Andy Schectman exposes why physical demand keeps rising even as headline prices suggest the opposite.
When that stops, and there's no one silly enough to send what is left, then you begin to see a transformation where these countries who are now all connected with their systems and their vaulting infrastructure will be the ones that control what the price truly is. I believe that any exchange that can say oil is negative 40 a barrel shouldn't be an exchange, in my opinion.
All right. So let me ask you this. So, you're basically making an argument for a future dramatic upward repricing in the precious metals, sort of when this new system sort of fully becomes operational and sort of decouples from the US-centric business as usual. There's also a bunch of arguments to be made for an upward repricing, immediate or gradual, for the precious metals, with things like, the depreciation of purchasing power of fiat currency in general, right? I mean, that's happening separate from everything that you're talking about. Whether we maybe have another debt crisis in this country, maybe we just have a bad bear market and people fly to safety. Like, there's a whole bunch of other reasons why the precious metals could go up in addition to what you're talking about. Now, the key issue is we don't know when of that, right? Could happen next month, could happen 15 years from now, right? We don't know. A lot of those are sort of, forces that are going to be increasingly making themselves felt as time goes on here. Where I'm going with all this is, when I hear you talking, I'm torn. I'm like, okay, well then why should I buy precious metals if they're being suppressed?
If this continues for another decade, savers could discover that purchasing power disappeared, while asset prices appeared stable. According to Andy Schectman, the timing of any major repricing remains uncertain, but inflation, debt accumulation, and currency debasement continue regardless of market sentiment. The contradiction is that many investors avoid metals because prices seem controlled, while simultaneously acknowledging the forces that make hard assets attractive. Waiting for certainty often means paying much higher prices after the market finally adjusts. Next, Andy Schectman reveals why the biggest risk may not be suppression itself, but assuming it lasts forever.
And everybody right now, all the power players or the government wants them suppressed because our military industrial complex wants to buy silver on the cheap. China wants to buy gold on the cheap for its Enbridge and world domination goals. Like, why would I fight against powers that are much bigger than me that are pushing the price a bit down? And I would think your answer is, but I want to let you say it yourself, is, hey, yeah, we don't know, but at some point that game's going to be up. And that's why you say, I just think we should all dollar cost average. You said your dad told you to buy precious metals every 2 weeks or whatever. Just keep buying, because the trend is your friend here. It's going to probably just be a rising tide, but it's going to get punctuated at times with these dramatic repricings whenever they happen. And your point is look, I can't tell you when the repricing is going to happen, so don't buy right now. Don't shove everything in right now expecting it to happen tomorrow. But if you just keep building your exposure, at some point those breaking points are going to work to your favor. Did I capture it right?
Yeah, it's the old cliche of seeing the trees instead of the forest, or the leaves instead of the forest. The trees and the leaves, the rustling leaves catch your attention instead of seeing the whole forest. They're using, I believe the rest of the world has become sophisticated, coordinated, motivated, educated, and they're standing for delivery using our Western system against us, where no one ever did that.
This happened before multiple commodity repricings. Investors fixated on short-term volatility while institutions accumulated quietly. What Andy Schectman is highlighting is that timing major breakouts is far less important than recognizing persistent structural demand underneath market noise. The real question isn't whether powerful players influence prices. It's whether those same players are accumulating the assets they publicly ignore. For long-term investors, gradual exposure often matters more than predicting the exact catalyst. Next, Andy Schectman unravels why physical delivery trends may matter more than daily price charts.
And so the idea of suppressing price is delinking the rationale that the rest of the big money in this country and others would have. Why would you look at gold and silver when it's not performing in the face of a war and inflation? It's exactly what they want you to believe. But at the same time, the Kobayashi letter came out and said that U.S. Treasury total returns, the index, has been in a drawdown for 69 consecutive months, the longest streak in over a century of records. You're talking about the asset the entire world treats as being the one safe place to park money has quietly become one of the worst performing investments for the better part of 6 years. And so what that says to me is that quietly these countries are selling treasuries to buy gold, which using the Western stupidity against us. So we don't want everyone to realize that. It's bad enough that the big money across the global South gets it, but you can see it by the deliveries. It's kind of like the casino is what is confusing everyone. If you look in the cage back there, you'll see that the big money is quietly exiting stage left with as much in the way of chips as they can. And it's the deliveries across the globe, if they were not the way they are, if you didn't see the central banks buying at the level they are, or the deliveries across the globe out of Shanghai, out of the LBMA or out of COMEX being what they are, where the exchanges have to lie like the LBMA about how much is actually leaving, or you have to have glitches on the exchange.
The safest asset in the world has spent nearly 6 years in drawdown territory, yet few financial headlines treat that as a crisis. Andy Schectman's argument suggests investors should watch institutional behavior rather than official narratives about safety and stability. If sovereign buyers are reducing exposure to debt while increasing exposure to gold, that's a signal hidden in plain sight. The danger for savers is assuming yesterday's safe haven still carries the same risk profile today. Next, Andy Schectman reveals the contradiction between public confidence in bonds and private institutional positioning.
To mitigate the price rise or to accentuate the price fall, or you raise margins 300% into the rebalancing of the ETFs the first 2 weeks of January, the stupidest time in the world to do it, you're guaranteeing a collapse. These are all things that would be emblematic of last-ditch efforts to mitigate what is a trend in motion, using misdirection of price and rhetoric to reposition. And the big money has the ability to do that. And there are a lot of reasons why they don't want to be upfront about it, but I think you can see it if you take a step back. And these people, they don't do things for the hell of it at that level. When you see 9-figure deliveries every month, whoever's doing it, they're not doing it for the hell of it. And I just simply think that that's all that you really need to see to know where ultimately, the music stops.
Okay. So to this point, we'll talk a bit more about it at the end here, but to this point about just, the smart thing to do then as an individual is just keep slowly grinding, your exposure higher over time through dollar cost averaging. Obviously, folks can do that through your firm, Miles Franklin, and you have, we talk about it all the time, but you've got phenomenal staff there that can help people do that and set up these automatic payment programs and things like that. I'm one of those clients, full transparency. But you have also been very generous in recent months, offering a special offer to this thoughtful money audience to be able to buy junk silver for below spot at basically at conditions that you've said you've never seen before in your career here.
Markets are supposed to reward price discovery, yet sudden rule changes often arrive precisely when trends become inconvenient. This is where Andy Schectman's thesis shifts from price action to market structure, focusing on margin increases and unusual delivery activity rather than headlines. 9-figure deliveries don't occur because institutions are bored. They occur because someone sees value where others see volatility. For investors, understanding incentives may be more important than predicting the next move. Next, Andy Schectman exposes why extraordinary physical demand keeps appearing, despite narratives designed to discourage participation.
So you're taking advantage of this and you're letting our audience come along for the ride, which is fantastic. We've been telling people, given you the pricing that you've been offering, which the last I've heard was $2 below spot, which is crazy. We've been qualifying that by saying while supplies last. Where are we on that right now?
It's going to be, for your listeners, right there. We wrote on the last price list below spot because some items are a little higher, some are a little lower. But I will make it known again for your listeners that it's $2 under spot, as it should be right now for you guys. I've never seen that. The fact that it's still doing it is just insanity to me. And the fact that it was $9 or $10 over bid, I would have paid you for 3-4 years during the pandemic, shows you both sides of it. Most of my career, it would have been spot or a little over when you sell it back to us. And as much as 9 or 10 over during the pandemic, and now being able to buy it under spot is unheard of. It's just one of these deals where it's an anomaly, and anomalies are often, price distortions are often, they don't last long, but much like the arbitrage in China and now in India that seems to be lasting longer than one would think, this has too. And the refineries are still messed up from the beginning of January when they raised margins the way they did, and it really put a strain on the market. Now, here's the truth of it.
A market claiming silver is abundant shouldn't be offering historically abnormal discounts at the same time. Andy Schectman notes that buying physical silver below spot was virtually unheard of for most of his career, making this less a valuation signal and more a sign of market dislocation. The overlooked issue isn't the discount itself, it's what caused it. Refinery stress, margin distortions, and lingering supply chain disruptions. For investors focused on preserving wealth, temporary pricing anomalies often disappear long before public confidence returns. Next, Andy Schectman exposes why this discount exists alongside persistent global demand.
The truth of it is that when we saw the price rise the way we did in this spectacular fashion we still had very good, strong business. But a lot of people had it. And with the volatility. If you are new to the precious metals industry, you may not understand this. For those of you who've had it long enough, you understand that it messes with your emotions. It's counterintuitive and it's moves. The questions you've been asking me are emblematic of what you see continuously and have for years in this market, but it continues to somehow go higher. But if they were to allow it to move in maybe its fashion that it should, it would be much easier to play. But the volatility, the corrections, the counterintuitive, like you said at the onset, the sawtooth, all of this stuff freaks people out, so they sold. And I would argue that there was more selling into that rise than there was buying, which tells you that the buying had nothing to, the rise in price had nothing to do with the public. It had everything to do with the big central banks buying it and the sovereign wealth funds. And so what you saw were dealers being overwhelmed with rising margin costs, with lots of selling, and not as much in buying on the other side to offset all of the outlays on cash. And to have $50 million sitting in a margin account when you have 2 million ounces of silver, when they jack rates up, margin rates 300% into the rebalancing, which creates a collapse. The whole thing got messed up. And if you're a refiner and you have metal that you bought from the public, you're hedging it on the downside.
Markets went up, but investor confidence went down. And that divergence rarely ends where the crowd expects. According to Andy Schectman, much of the recent buying pressure appears to have come from central banks and sovereign funds rather than retail investors chasing momentum. That's a direct contradiction to the popular narrative that price surges are driven by speculation. The emotional volatility shakes out smaller holders while larger institutions quietly build positions. Next, Andy Schectman unravels how margin policies may have amplified market chaos far beyond what most investors realize.
You're selling short to offset what you have in that you're working on refining.
Yeah.
And the price kept going up so fast, their short position was getting margin call. And then they're raising margins, more margin. And if you don't post that margin, you get stopped out in 24 hours. And so it literally destroyed so much of what normal is in our market and in the refining industry. We're still digging our way out of that. And I guess the offshoot of that is anomalies like what we're seeing in junk silver and what's happened to the refining industry, and it's played havoc on people's psyche. And it really did a disservice to this industry because people think, well, you're always going to get below spot when you sell stuff. I've never seen that in my career, ever. Like, except maybe kilo gold bars and 1,000-ounce silver bars, which were always a couple bucks back a spot. But to see it happening across the board and things like junk silver, this is a byproduct of messing with the system that I think they would be very silly to do that ever again, because the unintended consequences, I think, were extreme.
Okay, so a couple questions on this. One, the system is healing though, like it will here, right? This, to borrow an analogy I've used elsewhere, it's sort of like a pig through the python. There's just so much inventory that swamped the refiners. They're still choking on it, but eventually they will get back to where they were before. Yeah. And presumably this discount on junk is going to really narrow versus its extreme today, right? Which is why you're able to offer this opportunity. Let me just let folks know too, if you want to take advantage of Andy's offer here, this junk silver, talk to his team about it.
This happened before previous commodity squeezes. Market plumbing broke first and prices reacted later. What Andy Schectman is highlighting is that forced liquidations and escalating margin requirements can create distortions that have little to do with underlying demand. When refiners are managing survival rather than production efficiency, price signals become unreliable. Investors who mistake temporary dysfunction for permanent weakness often sell at precisely the wrong moment. Next, Andy Schectman reveals why today's unusual discounts may actually signal stress beneath the surface, not abundance.
Go to thoughtfulmoney.com/buygold. And obviously, if you've got other questions as well about buying gold or precious metals or storing them or selling them or whatever, his team can help you with that as well. All right, so to get to the title of this program, as I sort of teed up at the beginning of the discussion here, Andy, if someone were to ask you, and I'm not holding you to this, I'm just asking for you for your gut feel as a guy who's lived with the heartbeat of this industry for decades.
Yep.
How much lower do you think the precious metals could go here? I'm not saying this is a price prediction, but I mean, would you be shocked to see gold with a 3 handle on it? Would you be shocked to see silver below 60 an ounce here? I know these things could happen, but given the dynamics, do you think that's more likely, less likely, what?
I would be shocked to see silver break the 65 level or thereabouts where it was the last collapse that we saw, which, as the BIS, Bank of International Settlements, called structural, not fundamental. Wasn't fundamental, it was the raising of margins into the rebalancing of the ETFs that has to happen every year the first 2 weeks of January. It showed that the physical demand globally was far higher than that price justified. And the $10, $11 premium we're seeing around the world also exemplifies that. And the same thing is true with gold. What you have right now is the inability to continue to naked suppress the price of gold and silver because the rest of the world will stand for delivery. So you'll see great volatility.
Nobody's talking about global physical premiums, yet they may tell a very different story than headline prices. Andy Schectman's argument suggests the market already tested where real demand emerges, and buyers responded aggressively when prices were pushed lower. The key contradiction is that paper pricing can fall sharply, while physical buyers become even more active. For investors, the danger isn't volatility itself. It's assuming volatility automatically means weakening fundamentals. Next, Andy Schectman exposes the specific positioning tactic in COMEX, reporting that hides true institutional demand.
I would be shocked if you saw a 3 handle on gold, and it would last a matter of seconds. Okay. As the arbitrage would just gobble it all up. So I don't know. I think you're seeing higher highs and higher lows. So if you had silver go down and somewhat try and test that low that we saw in January, I don't think it violates it. And the same thing is true with gold. Physical demand is far greater than the ability to keep it down now. And that's, again, this is not retail driven. And it's that type of volatility and that type of thought process that keeps a lot of people on the sidelines. And that's exactly why those that paint the tape, those that move the price, tugging on our emotional heartstrings, they understand it. They're good at it. And yet the price continues to march higher. I would argue, Adam, it's been this way for my entire career. For 35 years, this is the kind of, now granted, we've seen the big moves over the last several years, but it's the same playbook. Volatility within a tight trading range until it breaks out, then a crash, volatility within a tight trading range until it breaks out. And they're doing it to take as few people along for the ultimate ride as possible. And they do a good job at it. That's why I think the people who have sold have largely sold by now and transferring it to the strong hands. I don't see those numbers being violated as a guess. I don't. I know Michael Oliver sure doesn't.
If this cycle continues another few years, the biggest losses may belong to investors who waited for perfect clarity. This is where Andy Schectman's thesis shifts toward market psychology, emphasizing how volatility repeatedly drives weak hands out while stronger buyers accumulate. Higher highs and higher lows matter because they signal resilience despite constant attempts to shake confidence. For retirement-focused investors, emotional decision-making often creates more damage than market corrections themselves.